this is the fun slide here. What is a non-qualified mortgage? Non-qualified mortgages, which we call them non-QMs, are alternative mortgage loan programs designed to help borrowers who can't qualify using standard document programs like a conventional loan or an FHA or USDA or VA loan. These government and conventional loans have set agency mortgage guidelines, which may disqualify many borrowers. For example, if you are self-employed or need all the necessary documentation to qualify for a traditional mortgage, you should look at non-qualified mortgages. Without non-QM loans, certain people could not purchase their homes. These loans are not backed by any government agency and are not considered portfolio products. So I can tell you, look to the right and it says asset qualifier. We have a bank statement loan, debt service covered ratio, which is for investment properties where we'll only look at the income coming from the property and not so much your income. We're not qualifying you based on your income. There's a second mortgage and a HELOC, I-10 loans and foreign nationals. Excuse me. And then we have a P&L program. Non-warrantable, if we can't get that condo that's non-warrantable, we could most likely do it on a non-QM loan. And there's no ratios. There's a 1099 and a written verification of employment that we use. So let me elaborate just a little bit. I recently was working on a file that was a bank statement loan. This person was a self-employed borrower, and they own a restaurant, and they were depositing over $1 million a month. And if we looked at their tax returns, it only showed that they made $8,000 a month after all of their deductions and their write-offs. But if we were to look at all of their deposits, because we don't care how much money comes out, we're only looking at how much money is deposited per month. We looked at the last 12 months, they made $48,000. So that gave them so much more buying power to buy the house that they needed for their family. However, there are higher fees. There's like a 2.5% origination fee, and the interest rate is a little higher than if you were doing your traditional conventional loan. We also do the I-10 loan. I-10 loans basically mean you do not have a social security number. And I think on Maui, it's going to be something that is going to be more standard as far as an I-10 loan, because I believe that there's a lot of farmers. And what happens is sometimes they'll get a permit to come and work and it expires and they just don't go back. But they continue to file tax returns with the tax identification number. And so what we'll do is we'll look at that and see how much their income is on that. Another thing that we'll do is look at, let me see, I don't know how to put this because I know it's being recorded too. Okay, let's say they're working for a farm and they have a social security number that was not issued to them, but they've been working under this same social security number for many, many years. So what we'll do on a non-QM loan is not ask for a pay stub, but we'll ask for a written verification of employment and income. And that does not have a social security number on there. So we can use that to qualify them along with their I-10 tax returns. So that's usually for a foreign national.
I have a quick question. For this non-qualified type of loan, and if I was working or looking to purchase an investment property, and would this type of loan have restrictions on someone, like if I were trying to get cash funds or capital through a private money lender for the down payment, and that money lender will put a second lien on the property, are there restrictions like that with this type of loan?
You know what? I'm not exactly sure. I'm going to say yes, but I will get an answer for you and I'll shoot an email. And if all of you want to know the answer to that, I'll just send it to everybody.
Yeah.
Because there's normally they want to see that it's either your funds or a gifted fund from like a qualified person who's able to give you a gift, which would be a family member or an employer or someone that's close to you in relationship.
Okay.
So I'm thinking, yes, there are going to be restrictions on that, but I'll confirm that for you.
Okay, thanks.
Okay. And then there's no ratios, which really means that we're not verifying your income to do this type of loan. And again, just keep in mind, they're doable. And in our company, God, I'm going to say the majority of the loan officers, they do non-QM loans. And they're getting them done left and right. They have relationships. We actually use investors to do these types of loans for us. So we have like a number of different investors that are willing to do it. So if there's one that has a better program than the other, then we'll look at that one and just see who can actually get it done for you. So here's your pros and cons that I promised you. Same application as a traditional mortgage, lenient guidelines requiring less proof of income and docs, products available for foreign nationals. Investors are not limited to the number of finance stores they can own. That means on conventional loans, usually they'll say you can't own more than 10 properties or 8, whatever it may be. There's no limit. You can have 20 or 50 different properties and they're still going to go ahead and allow us to do your loan. Here's your cons. Interest rates and fees may be higher, non-challenging to find, down payment requirements may be higher because sometimes they ask us for 20% down or 15, and they do require you to have higher credit scores, but it's not going to be any different than conventional as far as those credit scores go.
Oh, quick question. For the non-QM loans, you might have said it, but I missed it. Is it only for investment properties or can you do it as a primary?
You
So
do primary.
This would be a good option in the sense that like an HOA, because they're not going to look at the HOA docs, right?
Right. So those would be like non-warrantables to get those done. The ones that are investment are their DSCR. That's this right here. You're going to hear that over and over, that acronym DSCR, debt covered ratio. And that type of loan, they're only using the income. Like if it's a rental property and it's already producing income, then they're going to use that income to qualify the loan.
So I'm thinking like if a buyer was trying to put an offer in a particular condo, but their loan didn't get approved because of the HOA docs, like this could be an option.
It is an option. Yeah, that's what a lot of our loan officers do. They're like, hey, if it's not going to go warrantable, FHA, we just can't get that HOA approved, then they'll do this. And it always gets funded. Another one, the P&L, the profit and loss. So if they're self-employed, they can just do their own P&L. And then if their tax person, their preparer will just sign off on it. We don't need a CPA to, give us their, little seal of approval. We can actually have their tax preparer just put a P&L together for us. And if they say that they don't need to use more than 25% of the income, they lend us more money, like the loan to value is higher. So that's kind of a cool feature as well. Okay. So who benefits from non-QM loans? Investors who are capped at the allowed number of doors financed. Like I said, in conventional and FHAs, they may not allow you to have so many properties. There's no cap here. And mortgage borrowers who are self-employed and do not meet the debt to income ratio requirements due to the business expenses. That was the example I just gave you on that restaurant owner. Home buyers with a prior bankruptcy or foreclosure who have reestablished themselves but did not meet the minimum waiting period, which is either 4 years for a Chapter 7 or 2 years for the Chapter 13. Home buyers who have late mortgage payments in the last 12 months on their previous mortgage. I guess it's not that big of a deal if you've been late on a non-QM. Retirees, self-employed, entrepreneurs, traditional income or regular job. I can imagine you guys get a lot of that because I know that you guys, realtors here in Hawaii, you get a lot of cash buyers that are like 1.2 million, 2 million, and it's all cash. And instead of, I personally would say instead of using all of your cash, purchase one property, get a non-QM loan and buy multiple properties and start making some. And whatever you make on those rental properties will most likely cover. Just food for thought on that. High-end home buyers who cannot qualify for traditional jumbo loans as well. So there's lots of options when it comes to non-QM. So if you ever have anything that you're just not sure of, or shoot me an email or call me and I'll look it up for you and I'll get some answers for you just to see if there's any options that are better than what they have in front of them, their traditional loans.